Hi, welcome to Calibre Investment Market and Portfolio Update for October 2022. The inflation genie is well and truly out of the bottle, so we'll be covering that. That's the main driver of the presentation today because that's the main driver in financial markets, and that is the main driver in terms of results people are getting in their portfolios. So we'll look at central banks and the response to that. China is slowing. We're going to cover a bit about that. And then we'll finish off with how the portfolios are travelling through this period. So we went to the Bank Credit Analysts Macroeconomic Conference in New York in September. We felt it was pretty important to actually get on the ground and start talking to some of the policymakers and some people who have pretty high levels of influence in the financial markets about what's going on, because it's such an interesting period at the moment. So we thought it was pretty important to get up there and actually cover that. So we'll be covering some of that in the presentation today. For example, one of the keynote speakers was Richard Clarida, who is the US Federal Reserve Deputy Chair of the Federal Open Market Committee. It's a bit of a mouthful, but essentially that's the committee that sets their OCR for the whole of the US economy. So he's just stepped out of that role. He had some really good insights as to what's going on at the moment and where that Fed policy will go. And so the Fed, as we stated initially, the inflation genie is well and truly out of the bottle. The central banks have pretty much lost control of inflation. So one of Richard Clarida's major points was that the US Federal Reserve, and it's probably true of most central banks, but the US Federal Reserve had lost credibility with the financial markets because the markets felt that they had let the genie out of the bottle, and that inflation essentially was out of control and that they need to get it back under control. And so the big issue there in terms of the central banks getting it back under control is they have to make a real commitment to getting it under control. So what does that mean? When inflation got completely out of control in the 70s and 80s, it took Paul Volcker, who was the Federal Reserve Chair at the time, to come in, and he really tightened up conditions. But when he did that, he drove the US and the global economy into recession. And so that's the big issue at the moment, because it's clear that inflation is going to shape the landscape for quite a while. This is not something that younger people know about. The last time we had elevated or double-digit levels of inflation was during the 70s and 80s. So there's not a lot of experience for younger people about this. And so what's that mean? If we look at the levels of inflation, we are seeing elevated. We've got elevated levels of inflation. We've got 10.1% in the UK. The US has dropped down to 8.2%, but it peaked out at 9.1%. And New Zealand, of course, has well and truly joined the party with 7.2%. So these are eye-watering levels of inflation, because these levels of inflation really do eat away at people's real purchasing power. And essentially, for when you're earning the same level of money, you're just getting so much less for your dollar. It's pretty critical because the Bank of England is forecasting inflation at 13% this winter. A lot of that is going to be driven off the back of gas prices, with Putin trying to punish the UK and trying to dissuade them from supporting Ukraine in the war further. So the response from central banks has been pretty hard and fast. We're looking at 0.75% increases for the US, 0.5% increases for New Zealand. So they really are playing catch up quite hard and fast. And you'll see with the graph that we've got up that the response is coming on hard and fast, but the relative levels are still pretty low compared to where inflation levels are. But this period does represent one of the hardest and fastest increases in interest rates in response to inflation that we've seen for a long period of time. So the other element which isn't getting a lot of press at the moment is outside the rise in interest rates has been the move from quantitative easing to quantitative tightening. And so what that means, when we had quantitative easing, the central banks were buying bonds, they were trying to lower the costs of borrowing, they were trying to boost spending, support economic growth, and they were also ultimately, ironically, targeting inflation to try and get that stimulus back into the economy. They were doing that because we were looking down the barrel of a fairly nasty recession off the back of the closure of economies and the pandemic. So what the central banks have shifted to now is actually quantitative tightening. And so essentially you're reversing all of those. They're trying to raise borrowing costs, lower spending, actually slow down economic growth, and of course they're trying to reduce inflation. So rather than buying bonds, the central banks and the Federal Reserve, the Federal Reserve now has a balance sheet of $9 trillion US dollars. Before the GFC, it had a balance sheet of around $600 billion. After the GFC, that balance sheet had risen to about $4.5 trillion US dollars. That's with all of the purchase of bonds and so on to stimulate growth in the economy. During the pandemic response, the balance sheet doubled again to $9 trillion US dollars. So what they're doing now is, in quantitative tightening, they're actually reducing that balance sheet. And so instead of replacing bonds that mature, they're actually letting those bonds roll off and not replacing them. From June 1 this year, they were doing that to the extent of $47.5 billion US dollars a month. And from 1 September, they're starting to do that at a rate of $95 billion US per month. In New Zealand terms, that's around 150 billion New Zealand dollars, or well north of New Zealand's total GDP in 2 months of shrinking that balance sheet. So that hasn't been getting a lot of press, but that's actually having a big impact in financial markets, because you've got now the central banks around the world, especially the US Federal Reserve, were major participants in those financial markets and those fixed interest markets. They're now disappearing and they're now absent. So we're starting to see a lot more pricing from a pure market perspective rather than central bank manipulation. And so what's happened is we've seen actually a really big lift in bond rates. Remember, we stated in the past that the New Zealand 10-year bond rate was 0.5% back in the middle of 2020. That 10-year bond rate now is 4.7%. So that's a really big lift in those bond rates. And that actually represents a big capital loss for bond investors on a mark-to-market basis, or if you price it daily on that basis, that actually represents quite a big capital loss. And that actually has been reflected in some of the results that people are seeing in their funds, not our portfolios, as we don't have such a big bond exposure. But in other portfolios out there, people have been impacted by that quite a bit. So, as we said, Volcker, back in the 70s and 80s, had to essentially create a recession to actually get inflation under control. So that's the big question now, is what's going to happen to global growth. We know that interest rates are rising off the back of the central bank response to inflation. Just a few months ago, the global growth forecast from the International Monetary Fund had advanced economies up at about 4%. The US was going to be about 4%, which is pretty solid growth for these developed economies. But now we're looking at the fact that technically the US is already in recession, 2 negative quarters, although it was pretty flat. Europe is pretty much in recession. China is struggling, and we'll get to that in a second. And the UK is probably in recession, especially with what's going on at the moment. As we go to where Truss has just resigned, and so obviously that's also been causing some ructions in the financial markets as well. So moving on to China. So China is the second largest economy in the world, and after the global financial crisis, it actually provided 30% of global growth. So it was a real economic growth engine that helped the global economy recover from the global financial crisis. So it's facing some real headwinds now, led by a big problem in the property market. Evergrande, unfortunately, really is the tip of the iceberg. So a lot of the property developers have got real problems with debt and have been failing. As we know, that a lot of the mortgage holders holders are refusing to pay their mortgages in protest about non-completion of their homes, units, apartments and so on. So the property sector has been a big driver for the Chinese economy, and so that was a really good outcome from the macroeconomic conference in New York, as we got some real insight as to how that property market, how that's going to develop, and we can cover that in another video at some point. The other thing that has been heading off growth for China has been the clampdown on tech companies. That has pretty much finished now, but that has caused a slowdown in growth as well, because the Western tech companies were certainly clamped down on in terms of their activities, because they were occupying space that the Chinese government wanted, and so that was a headwind to growth. And the other area that has been a headwind to growth has been non-bank finance. So this problem has been around for a few years. The government certainly has a balance sheet to sort it out, but it is causing problems, and it's not unrelated to the property development sector. And of course, the other big problem that China has had is that they've imposed a pretty strict zero COVID policy, and so we've been seeing lockdowns in Shanghai and Beijing. The problem that you have when you lock down cities of that size is you're locking down 21 million people at a time, you're locking down factories, ports, industrial growth and so on. So that's been a big headwind to growth. So what that means is that China is definitely not in a position to grow strongly or provide that economic growth driver we've seen before. So just moving on to jobs, because this is the element that is causing the central bank's real concern. It's quite positive in one way. The unemployment rate at the peak of the pandemic in the US was just about 15%. That unemployment rate has dropped down to 3.5%. That economy is seeing what most developed economies are seeing, including New Zealand, is real skill shortages. The ability to get skilled people is very difficult for employers. What that has meant, of course, is that the cost of those skills has gone up as well, because they're now scarce. People are now demanding and getting quite substantial pay increases. So the US added 528,000 jobs in July, as we can see from this slide. It wasn't just in one sector. It wasn't just employing people a huge amount of people to clear tables and so on. It's a pretty full court press across manufacturing, retail, construction, professional business services and so on. So that's a sign of a pretty healthy economy, actually. And healthy jobs growth. And so they added 315,000 jobs in August and another 208,000 jobs in September. So you would think that's very positive. Of course, the central bank doesn't want to see strong jobs growth because they're trying to get inflation under control. So if you're seeing strong jobs growth, strong income growth, plus wage increases off the back of scarce skills, that's obviously going to add to the inflation pressures, not reduce them. So that's not something the central banks and the Federal Reserve want to see. And so the US wage growth was 5.1% year on year for July 2022. So that's massive. That 5.1% across the largest economy in the world is a lot of wage pressure. New Zealand's wage growth has been 3.4%, which for us is pretty strong as well. So the central banks are behind the curve. They probably left the stimulus on for too long. At the beginning of 2021, when it became clear that vaccines were going to enable us to open economies again, that was probably the time we should have seen some scaling back of the stimulus from central banks. Unfortunately, they hung on for another year, and then inflation really took off at the back end of 2021. So the numbers are way too high to ignore. And so now, as we said before, they're trying to tamp down inflation, but they're trying to do it in a way that they don't drive the economy or economies into a really deep recession. So Jay Powell, who heads up the US Federal Reserve, just recently came out and said he would like to to say that there was a way of doing this without some pain, but there isn't. So essentially what he's saying is that they're seeing that they may need a recession before they see inflation coming under control. What they're trying to do is engineer what they call a soft landing or a very low or light recession. And what that means is just unemployment ticking up a bit and a little bit of disruption, rather than, say, a deep or a hard recession, or a hard landing rather, where you would see unemployment ticking up by a lot, business failures, disruption, economic disruption and real disruptions to people's lives. So that's obviously what they're trying to do. It's a pretty blunt tool and an inexact science, so engineering that is a lot more difficult than it seems. So they're getting some assistance from the fact that we saw really high oil prices from the war in Ukraine, topping out at about $123 a barrel. That's now come down to $80 to $90 a barrel. So some of these supply side factors that started off this inflation cycle are now starting to drop back, and reduce some pressure. We're seeing things like commodities, iron ore prices and so on come down as well. Shipping costs are coming back, so some of those supply chain issues are starting to, the pressure's coming off there a bit as well. Lockdowns in China don't help, but generally we're seeing a bit of progress there. So what's happening is that the inflation pressures have moved from the supply side to the demand side, and that's right back to where we started from in terms of that wage growth. So the thing that keeps central bankers and Treasury officials awake at night, the really scary thing for them is embedded expectations, or what they call an anchoring of inflation expectations at a much higher level. So they'd rather see inflation expectations anchored at around the 2% level. The problem is what they're wanting to see is an avoidance, and we may already be into it, and we probably are, is a wage price spiral, and that's what keeps them awake at night. So if you're an employee and you're seeing your cost of living, when you go to the supermarket, the prices are up, so you go to your employer and ask for a cost of living increase in your pay. The employer says, yes, that's fine, and grants that, but then that employer then has to put their prices up to cover the cost of the wages, which have just increased. They put their prices up, but of course that employee is still a consumer, so then they're seeing higher prices, so they have to go back and ask for an increase in wages. And so you get a very nasty, vicious cycle of a wage price spiral, and what that does is embed inflation expectations at a much higher rate, and that means it's really problematic for the real economy, causes real damage in the economy, and that's what the government officials and central banks are desperately trying to avoid. But it's this expectation of higher inflation, higher wages and so on that the central banks are grappling with. And that's why now we're seeing some strong suggestions that central banks may continue to raise rates, interest rates, even when they see signs of recession, because they're worried that these expectations are embedded in the economy. So the big question then is, we know that there's probably going to have to be a recession to get inflation under control from these levels. The big question is it going to be a soft landing or a hard landing? And of course nobody knows that at the moment. That is the $64,000 question for the financial markets, and that's why you're starting to see a lot of movement in the financial markets, and we've seen that in equities. So as we know, shares, equities don't like rising interest rates because it increases the cost of doing business. It also increases the attractiveness of alternative assets like bonds and cash and so on. So we've seen a full bear market this year in equities and stocks, and a bear market is defined by being 20% down. So we've seen that the large cap growth stocks have been impacted more heavily than the general market, so that's why some people out there are seeing quite big down movements in their portfolios because of that. So it's definitely hit equities as well as the bond market. So as we said before, while the rising interest rates does result in some more attractive rates out there, it has also resulted in some negative outcomes in terms of people's portfolios. And so those rising interest rates, of course, then flow on to the real economy through mortgage interest rates, and that's where obviously the central banks are trying to slow the economy down through an increase in interest rates, because that obviously increases the mortgage servicing costs for people, and that means they have less money to spend out in the real economy in terms of cars, clothes, anything that where increased demand might push pressure up. So what they're trying to do is actually reduce the demand out in the real economy by increasing interest rates on people's mortgages. And as we can see locally here in New Zealand, we're starting to see that effect of rising interest rates in terms of people's mortgages, and that will definitely be having an impact on their spending patterns and where they expect to be spending, because people will definitely be sitting down across the kitchen table and saying, okay, we've either rolled on to a higher interest rate or we're about to, and where can we cut back on expenditure? So the second part of the research trip to the Northern Hemisphere was to Lancaster University, where we attended a factor investing conference, or a risk investment conference. And so that was very, very useful in terms of further input into how the portfolios are constructed. Because what we've seen with the portfolios is that we have seen real ructions in both bond and equity markets, but the portfolios are tracking very well. So that's a result of effective diversification. We've spoken about this before, but it's at times like these that's really tested. And so unfortunately some people out there are finding that where they thought they had diversification in other portfolios, that hasn't occurred. But in the portfolios that we're running, it has been proven that we've got really effective diversification, and despite the market downturns in both bond markets and equity markets, you are definitely on track, because the portfolios are travelling very, very well through this period, because we've got diversification across sectors, within sectors. Things like currency, which is a very deliberate exposure, is playing its part very well. The New Zealand dollar has dropped about 20% against the US dollar, and that's gotten a lot of press, but that actually helps buffer the portfolios quite nicely. So the objective is to maximise the probability of you achieving your objectives, and we do that through very effective diversification. So some elements also are a result of a lot of work through the years in terms of research. So a lot of people have asked us, what are we doing now to get through this period? So the big problem with that approach is if an investment manager waits until they're in the middle of this cycle to try and do something to alleviate what's happening out there, then it's way too late. You need to do the work well before you actually hit these types of events. And so that's why we construct the portfolios the way we do. We know that for our clients with a 35, 40-year investment horizon, and it can be anything from 20 years through to 40 years, that we're going to strike some rough patches along the way. We don't know when those are going to occur, how they're going to occur, how long they're going to last, how deep, shallow, and so on, but we know they're there somewhere. And so that's why you've got to construct the portfolios in a way that accommodates those sorts of periods as well as the strong growth periods. And so that's what we're trying to achieve. That's why some of the components in the portfolio that are doing very well at the moment are a result of research over the last 5, 10, 15 years, and just making sure that we get those risk exposures, that we understand them, we research and analyse them, and then we combine them effectively to produce the right sorts of results. But that only occurs in alignment with ensuring that we've got the portfolios aligned with your objectives rather, because it's the alignment of the investment solutions with your objectives that's where the real power comes into it. And the other thing is that you're investing in not just a set of assets, because those that doesn't last forever. Assets change over time. What you're investing in is a process, and that's why we have the research, analysis, the modelling, portfolio construction, discipline, and the monitoring and review. So combining all of those process elements is what produces the results, not just picking the assets on the day. And so there's a lot of ongoing work behind the scenes that aren't always obvious, but that research comes into play in the portfolios you're seeing now. And things like the US dollar, that's a very deliberate exposure, but it means that, for example, the core equity exposure was only down 7% when other people are down 20 to 30%. And so we combine all of these different types of elements like equity, domestic, international, emerging markets. We have fixed interest exposure, cash, currency, and so on. But we also have things like the multi-strategy exposures, and they're a little technical. We can do some videos explaining those in more depth at a future point. But that's one sector where there's been a lot of research and analysis to make sure that we get the type of solution there right. And what we can see is that when equity markets have sold off quite a bit and bond markets have sold off, as you can see from this slide, we're getting really good results from our multi-strategy portfolios, and that's exactly what they're designed for. They're designed to help us through periods like this, these rough patches that we can't see coming, but we know these sorts of vehicles give us really good non-correlated exposures, and that's why the portfolios have performed very well through this period. So all components are very much performing in line with our expectations, and the combinations are performing well through this cycle, and so that's achieving one of the core objectives that we have here, is maximising the probability of preserving real purchasing power. Yeah, so it's been a pretty volatile period in terms of financial markets. We're starting to see some impacts in the real economy. We're starting to see, obviously, rising mortgage rates and so on. It looks like there might be a recession, whether it's going to be a soft landing or a hard landing, who really knows. But what you can rest assured is that the portfolios are tracking in terms of achieving your objectives, and that they're well constructed and positioned for what comes next. So thanks for listening. I'll catch you next time. Bye.